Hello everyone, thanks for checking out my video. After 3 straight months of losses, November is off to a monster start as the indexes rallied and smashed a few records. S&P 500 closed 5.85% higher last week, the tech-heavy Nasdaq gained 6.61%, and Dow Jones was up by about 5%. It was the best week for all three indexes in 2023, and the best since October and November 2022. To add on, Nasdaq has clocked the best weekly performance for all indexes in 2023. Not just that, S&P 500 has reclaimed key levels in the process, which is a bullish sign. With this, does it mean that the stock market is ready for a year-end rally? Amid the rally, there is one thing that I particularly don't quite like, which I will be covering in this video. And oh, there is something new to share for my options trades, so do stay on to find out more. S&P 500 had 5 straight days of gains last week, which means it was up for every single trading day. That's very impressive. The last time we had such 5 days of winning streak was in June this year. Anyway, last week's rally was likely triggered by two main events. First, it was Fed's decision to pause their interest rate hike campaign for the third consecutive meetings by keeping them at 5.25% to 5.5% range. Though Powell said that they haven't made any decisions about interest rate hike in future meetings, investors grew hopeful that the Federal Reserve's rate hike campaign is over. Many investors are seeing the elevated Treasury yields as a substitute for more tightening from the Fed. For information, there's one more FOMC meeting left this year, which is scheduled for 12 and 13 December. Interestingly, Powell mentioned that taming inflation will most likely require a slowdown in economic growth and dampening in the labor market. And guess what? The October's jobs report on Friday came in weaker than expectations, which is what the Fed wants. Basically, the US economy added 150,000 jobs last month, below the expectation of 170,000 jobs, and much lower than September's blowout figure of 297,000 jobs. Then we have the unemployment rate rose to 3.9%, higher than expectation of 3.8%. To add on, the average hourly earnings also missed expectation on a monthly basis, rising 0.2% in October, below than the expectation of 0.3%. All these are signs that the job market is really slowing down. From the stock market and investors' point of view, these numbers do take some pressure off inflation and interest rate concerns, while still reflecting a generally robust labor market. In short, with employment finally cooling but still in positive territory, investors are betting that the economy has hit a sweet spot that will avoid further tightening from the Fed and also a recession, a so-called win-win situation. In terms of market outlook, it is quite clear that the tumbling Treasury yields have been a major catalyst for the latest market rally, just as rising yields have caused the landslide in the stock market over the last 3 months. At the moment, it seems to be stabilizing below 5%, so from now till year end, keep tab on the movement of the yields. As for the Fed's monetary policy, the market is pricing in a less than 5% chance of a Fed rate hike in December, down from 20% in the previous week. Well, a potential pause in rate hike in December and falling bond yields are good news for the stock market, as investors are hopeful that the Fed will be able to guide the US economy to a so-called soft landing and avoid a recession. To add on to these two catalysts, do also pay attention to the labor market in the next few months. If the labor market continues to cool, yet not by too much, it could provide a stronger indication that the Fed's hiking cycle is really coming to an end. Okay, let's move over to the technical analysis section, starting things off with SPY again. But before I dive into the details, a quick recap. In my last video, I shared that given how bearish and oversold the market were, we are due for a bounce. It's imminent. And there we go, SPY bounced with 5 straight green candles. Check out this before and after photos. I hope this correct call deserves a simple tap on the like button from you. Anyway, apart from the 5 consecutive green candles, SPY has also reclaimed the 200 moving average and broke out of the purple downtrend channel, making it even more bullish. But, here's the but. I personally don't like this double gap up that we saw last week. For those who are not aware, gaps are usually filled about 80 to 90% of the time. With 2 gap up in 1 week, it means that the market went up too fast, and that's not ideal in a market rally, at least in my personal opinion. Therefore, I am expecting some form of resistance in the near term. By the way, here's a key lesson I would like to share with fellow viewers. If you realize, when the market was doom and gloom, I was calling for a potential bounce. And now that the market is rallying, I am anticipating sellers to step in. The key message or lesson here is, use technical analysis to anticipate the next movement from the market makers. But don't be too eager to step in yet. Wait for the market to move, look for confirmation, and then you move along with it. A lot of times, retail investors are late to the party. When the market was falling, they entered late with their puts and saw the market rallied and their puts get wiped out. Then, when they switch over to the long side and started to chase the rally, sellers start to step in and their call options get wiped out. Sounds familiar? Okay, back to the technical chart. One potential area of resistance where buyers will step in could be the all-important 61.8 Fibonacci level at around 439. That is also the bottom end of this green dotted uptrend channel. If we get a rejection here, I think there is a chance for us to retrace and backtest the purple downtrend channel at around 427 to 430, give and take a little bit. If SPY bounces from this point, then it's bullish, because at least one gap has been filled, and usually a backtest and bounce is a good sign. But if the market wants to go lower and fill the bottom gap between 423 to 426, it wouldn't concern me. In short, as long as we stay above the key level of 420, bulls are safe. On the upside, apart from the possible backtest and bounce, the other possible scenario could be no rejection at the 61.8 Fibonacci level. If we close above it, it means SPY will be back in this green uptrend channel. That's very bullish as sellers probably have dried up. When that happens, we have a decent chance of approaching the gap between 452 to 453. Let's now check out Apple's chart. In my last video, I shared that Apple was oversold on the RSI and we could have a technical rebound, which we did. So again, please give this video a like if you have benefited from my analysis. Anyway, Apple's earnings beat estimates on the top and bottom lines, but the stock fell on Friday as the company issued a soft sales outlook for the holiday quarter. In my view, the slight decline on Friday was a good one because it helped to fill the gap that was created the day before. Remember, gaps get filled 80 to 90% of the time, so it's good that it is filled now. And from this point, there is a chance for Apple to rally together with the broader market. Note, I am saying there is a chance, it's not guaranteed, okay? So what should we look out for to get the bullish confirmation? First of all, Apple needs to stay above the all-important 61.8 Fibonacci level and the 50 moving average. In other words, to stay above 176 to 176.5 this week. If this happens, the next resistance is the top end of this downtrend channel at around 179 to 180. If Apple breaks out of this channel and goes above the recent high of 182, then the short-term trend has turned quite bullish. I wouldn't want to have short positions when this happens. But let's say Apple gets rejected at the top end of the downtrend channel, it means Apple is still stuck in this bearish trend or downtrend channel. The support would be the levels that I mentioned earlier, the 61.8 Fibonacci level and the 50 moving average at around 176. Bulls wouldn't want this level to break. If that breaks and Apple don't reclaim it soon, we could slowly grind towards the 200 moving average at around 171. Further weakness could send Apple below the recent low of 165, just like how it has been creating lower lows since August this year. And in my opinion, Apple's next direction will likely depend on how it reacts to the top end of the purple downtrend channel. Moving over to Tesla, just like many other stocks, Tesla rebounded well last week by gaining more than 6% and even reclaimed the 200 moving average. That's bullish. It almost had 2 gap up like SPY, but luckily Friday's gap up was filled on the same day. Again, I prefer such gaps to be filled ASAP so that it can go higher. But that being said, we still have a major gap between 205 to 211 pending to be filled. Here's the thing for Tesla. Despite reclaiming the 200 moving average, it did not do it convincingly. It only barely closed above it. Therefore, come this week, if Tesla falls below the 200 moving average, then the bearish momentum could resume, and the gap below would then be bear's target. The gap area could act as a support, followed by the recent low of 194. If both levels break, bulls have to be very careful because we are talking about 170s and 160s range again. By the way, if you have found my content useful and would like to support this channel, you can consider buying me a coffee via my coffee page. It's gonna cost you only $4, less than a cup of Starbucks coffee. It's not gonna make you poor, not gonna make me rich, but it is definitely a good form of encouragement for me. Or you can also consider signing up for a Webull brokerage account using my affiliate link below, which is at zero cost to you. Sign up, deposit $1 and you get free shares, that's all. Alright, on the other hand, if Tesla can put one or two more green candles above the 200 moving average, that's a good sign. We could then charge towards the gap above, between 230 to 242. That's one big gap to be filled. Just to share, the top end of the gap coincides with the all-important 61.8 Fibonacci level at around 240, so I think we can expect some sellers to step in around there. To add on, there was a bullish divergence on the RSI and it actually played out with a solid bounce within 3 days. In fact, I actually saw a cash secure put after this confirmation bounce, which will be covered later in the options trading segment. The only thing that concerns me is really the gap up. If we didn't have the gap up, then I would be more confident with my option trade. Lastly, the MACD is about to have a bullish cross, though it hasn't happened yet. So I will watch this quite closely this week. If the bullish cross is confirmed, then Tesla's mini rally could continue. Let's now hop over to Google. Google, you are back to where you belong again. Remember this consolidation area of 127 to 139 that I have been talking about for months? Google is back here again. This is also the reason why I love trading cash secure put on Google, because its movement is so range bound. Not financial advice, but Google has not gone below 120 since July this year. So if you have been selling monthly cash secure put of 120 strike price, you would have profited at least 4 rounds across 4 months. Very quickly, let me show you my cash secure put trades on Google since July till now. I have opened 5 trades with a strike price of 113 to 120. 3 of them have expired worthless, and if the other 2 also expire worthless, the total profit for these 5 trades is around $700. Okay, back to the chart. Can you see that big gap between 129 to 137? That will be the bull's target. If the broader market continues to be bullish, there is a high chance for Google to follow its usual movement of grinding to the top end of the consolidation zone at around 139, which means the gap could potentially be filled. But of course, it won't go up in a straight line. One area of resistance would be the 61.8 Fibonacci level and the 50 moving average, which is around 133. A few green candles would make Google bullish, and then we could charge towards 139 to 140 again. If we get rejected at the area or any area, we can expect Google to float around 120 to 130, which is formed by the various Fibonacci levels. Bulls should only be concerned if Google falls below 120. Anything above 120, there is nothing to be worried about. So, does it present a chance to sell cash secure put? Well, I can't offer you financial advice, you can make your own decision. Moving over to the options trading segment, last Friday, 3rd November, I had 2 cash secure put contracts that expired worthless. The first is this one on Tesla, which I sold on 27 September with a strike price of 195. Tesla actually went below my strike price last Tuesday by hitting 194, but then it bounced up quite dramatically in the next few days. As it closed above my strike price on Friday, my contract expired worthless and I got to keep the full premium of $290. The return for this trade is actually not bad. Next, it was this cash secure put on Apple that I sold on 26 September with a strike price of 160 and I received a premium of $205. Ever since I sold the contract, Apple didn't fall close to my strike price at all. So last Friday, despite falling after it reported its earnings, Apple still closed way above my strike price, and my contract expired worthless. Together with a premium from Tesla's put, I made close to $500 for these two trades. Moving on, if you recall, in my last video, I shared that I decided to take the assignment of 100 Bank of America shares. So last Monday, this 100 shares appeared in my account, and on the same day, I saw a covered call against these shares. The strike price was same as my cost price, which is $26, and expiration date is 8 December. I received a premium of $80 as a result. If you are new to options trading, I thought to let you know that the loss you see on the right is not a loss at all. There is no need for me to buy back and close the contract. Come 8 December, if Bank of America stays above $26, my 100 shares will be caught away at $26 per share, which I have nothing to lose since I bought them at $26 too. Well, I could have waited for a while more to sell at a higher strike price for more profits, but I guess hindsight is always 20 out of 20. Anyway, what I will gain from this trade is the $80 premium that I received, as well as the upcoming dividend payout of $24 on 30th November. And finally, the initial $35 that I got as premium when I first sold a cash secure put. And in case you're not aware, this is called the options wheel strategy. I will have a video on this strategy coming up soon. So anyway, the total profit for this trade is about $139, less trading fees and dividend withholding tax. I mean, just imagine the market makers park their 100 shares with me, I get paid more than $100 for that. And then I return them on 8 December if Bank of America closes above $26. How nice, isn't it? It's like they are paying me rental for placing 100 shares of Bank of America with me for a month. Okay, for viewers who are new to options trading, you can check out my options trading videos, which I will link them at the top. Finally, last week I also opened a new cash secure put. It was on Friday, 3rd November, where I sold a put contract on Tesla with a strike price of $185, expiration date on 8 December. The reasons for this trade are simple. As shared earlier in the technical analysis segment, there is a bullish RSI divergence on Tesla's daily chart, and the MACD is about to have a bullish cross. On top of that, Tesla has reclaimed the 200 moving average. But here's a quick disclaimer, the MACD bullish cross is not completed yet, and Tesla has not reclaimed the 200 moving average convincingly as shared earlier. We need a few more green candles above it, then it's bullish. So these are the risks that I am willing to take. Anyway, to anticipate things may go wrong, I have given myself some buffer by choosing a strike price that have 3 decent support levels above it. First is the 200 moving average, which in a way could be breached again anytime. Second is the psychological level of 200. And third is the recent low of 194. That being said, I must admit this trade is slightly riskier than my other Tesla puts. Alright, some end thoughts to wrap up this video. With earnings season past its peak and key economic news cleared, some major uncertainties have been removed from the stock market. Things are looking great for the stock market. Here are some interesting information to share with viewers. The S&P 500 rallied for 5 consecutive months this year, followed by a 3-month sell-off from August to October. This is an unusual pattern in the history of the stock market, as it only happened 4 times since 1926, about 100 years ago. More importantly, such pattern has been typically followed by a period of strong gains in stocks over the next year. Specifically, the S&P 500 has gained a median of 12% over the following 6 months. To add on, the current pattern most resembles the pattern seen in 1975 and 2016. In those instances, stocks gained a respective 22.5% and 12.1% in the following 6 months. Okay, this rare pattern aside, the last 2 months of the year have traditionally been a strong period for the stock market, with the S&P 500 rising an average of 3%, according to data from CFRA Research. To add on, I personally believe that if the stock market continues to move higher from this point, we may see FOMO investors starting to feel as if they have to chase the rally in the final 2 months of the year, which can then bring the stock market even higher. Okay, it seems like all the statistics are pointing towards a solid end to the year and things are looking very rosy. But before you get all too excited, I just wanted to caution that technical wise, it's still possible that the new market rally will hit resistance after a strong surge last week. But that's not really a big deal because stock market moves in a zigzag pattern. It doesn't just fly to all-time high in a straight line. A pause in the rally is always healthy as it lets some big winners take a breather before climbing higher. Just to add on, yes, the last 2 months of the year are generally a strong period for the market, and just like many others, I am hopeful of that too. But again, hope is not a strategy, so please continue to pay close attention to Fed's monetary policy, the job market, the treasury yields, and of course the ongoing wars. These are all the potential headwinds that could spoil the party, but if everything is well contained, then yes, the possibility of a year-end rally is decent. Alright, that's all for this video. If you found my content useful, could you please help me grow my channel by liking and subscribing? Thank you.